Let me introduce myself. My name is Lance Hulbert. I'm a CPA with Huddleston Tax CPA. And we offer the Small Business Webcast. And the next webcast will be on March 2nd on LLCs and S-Corps Explained. Then there'll be another one on March 8th for tax savings for construction, architecture, and engineering firms. March 10th for tax tips for dentists, and March 16th for tax tips for the self-employed. So you can log on to that website if you have need more information. So today the topic is tax update, the Tax Relief, Unemployment, Insurance Reauthorization, and Job Creation Act of 2010. This past December, Congress authorized a comprehensive set of income tax, estate tax, and employment insurance provisions. This was approved by the Senate on December 15th, approved by the House on December 16th, and then signed into law on December 17th. So it was a very quick process once they decided on the text of the bill. This legislation basically keeps intact for 2 more years America's existing tax rate structure. It also temporarily fixes the alternative minimum tax, and it also extends a number of deductions and tax credits and provides a temporary 1-year reduction of Social Security taxes. It temporarily reforms estate and gift taxes, and it also provides a number of incentives for businesses to invest in equipment. But the theme running through this Tax Relief Act is that it is temporary, because everything in it will expire. Most of its provisions are temporary 2-year fixes that impact only 2011 and 2012. So what this means is that the Bush-era tax cuts that were scheduled to expire at the end of 2010 will now expire at the end of 2012. From a tax planning perspective, this gives taxpayers and their accountants an additional 2 years of certainty for constructing their tax strategies. With 2012 being an election year and a presidential election year at that, future Congresses and our next president will need to address our tax system comprehensively, since all of the tax breaks that were implemented under the Bush administrations and the Obama administrations will expire at the end of 2012. So let's look at the income tax provisions. The personal income tax rates for the 2011 and 2012 years will keep their existing 6-rate structure, which ranges from 10 to 35%. If the Tax Relief Act had not passed, the tax rates would have reverted to their pre-2001 levels, ranging from 15% to 39.6%. And combined with the payroll tax cut, which I will discuss later, this extension of the individual tax cuts will provide many individuals with a significant increase in the dollars available to them. And that's happening like this year in 2011. An example is an individual, say, earning $50,000 this year will see a tax savings of approximately almost $1,900 in combined income tax and payroll tax rate reductions. And also, this is important for individuals who converted a traditional IRA to a Roth IRA last year in 2010. They have the option to recognize 100% of the conversion as income in 2010, or to recognize 50% in 2011 and 50% in 2012. So they should consider deferring recognition of that income from the conversion into 2011 and 2012 because now we know that the lower income tax rates have been extended to those years. Similarly, capital gains rates will remain the same with a 0% bracket for taxpayers in the income tax bracket of 10 to 15% and a 15% capital gains tax rate for other taxpayers in higher brackets. And keep in mind that these rates, the 0% or the 15% rate, apply to both long-term capital gains and to qualifying dividends. If the Tax Relief Act had not passed, the 0% rate would have risen to 10% and the 15% rate would have risen to 20%, and dividends would have been taxed at ordinary rates instead of at the preferred rates. And the definition of qualifying dividends, this will be on your Form 1099, but basically it's the dividends from a domestic corporation or a qualified foreign corporation on which the underlying stock is held for at least 1 day within a specified 121-day period. And it's important to note that qualified foreign corporations can qualify for this if they are eligible for U.S. tax treaty benefits or if they have stock that is readily tradable on an established U.S. securities market. So this continuation of the 0% rate will be important to many taxpayers. For example, students, retirees, or others who live on their retirement savings. So to the extent that capital gains and dividends, when added to other taxable income for these people, for these taxpayers, does not exceed $34,500 this year or $69,000 for married couples filing jointly, then these capital gains and dividends are effectively tax-free, which is a great deal. Also, the tax reform has a what's called an alternative minimum tax patch. You know that the alternative minimum tax was originally began to prevent some middle income earners or high income earners from getting away without paying any tax at all, but it's been gradually creeping up over the years and impacting more and more people. So for 2010, under the tax reform, the exemption amounts were increased from $33,750 to $47,450 for individuals, and for married couples from $45,000 to $72,450. And so these increase in these exemption amounts should prevent some middle income earners from being subject to the alternative minimum tax, and for others will keep any alternative minimum tax adjustments to a lesser amount. So as you may recall, the alternative minimum tax is a parallel tax system. Taxpayers pay the higher of the regular tax or of the minimum tax. The difference between the two is calculated on the Form 6251. If the minimum tax is higher, then the difference between the two tax rates is added to the Form 1040 as an additional alternative minimum tax. So when calculating the alternative minimum tax, various adjustments are made. Some income which is not subject to regular tax is subject to alternative minimum tax. Some items which can trigger an alternative minimum tax liability would be itemized deductions for state and local taxes, medical expenses, and miscellaneous itemized deductions, mortgage interest on home equity debt, accelerated depreciation, exercising incentive stock options, even if they have not been sold, tax-exempt interest from private activity bonds, passive income or losses, net operating loss deduction, foreign tax credits, and investment expenses. Next, let's take a look at personal tax credits. The American Opportunity Credit has been extended through the end of 2012. This is the credit basically for college students, which provides a refundable tax credit up to $2,500 based on the first 4 years of undergraduate education. And this credit was to expire at the end of 2010. Also, the The enhanced child tax credit, if you have children under age 17, it's been extended through the end of 2012, providing $1,000 in the form of a partial or refundable tax credit. And if it had not been for the extension, this credit would have reverted back to its original maximum of $500. Also, the dependent and child care tax credit has been extended until 2012. It keeps the higher maximums of $3,000 for one child and $6,000 for two or more children. Then looking at how this has changed personal tax deductions, we have a temporary repeal of the dollar limitation on itemized deductions. And previously, this was only a one-year repeal for 2010, but now it's been suspended for 2 additional years for 2011 and 2012. And this affects itemized deductions for higher income earners. Also, the temporary one-year repeal of the phase-out for personal exemptions has been extended for 2 additional years. So that's for 2011 and 2012. The student loan, the deduction for student loan interest has also been extended for 2 more years. So after 2012, the deduction will revert to the previous tax law, which provided that interest on a student loan is deductible only for the first 60 months of repayment. Also, the sales tax deduction, which is important for those of us who are in sales tax states without income taxes, it's been retroactively restated for 2010 and extended through 2011. And this is an optional itemized deduction in lieu of the state income taxes, so it now expires in 2011. The tuition and fees deduction for college students has also been retroactively restated for 2010 and has been extended through 2011. Sometimes this deduction can be more beneficial than the American Opportunity or Lifetime Learning credits. The teacher's classroom expense deduction has been extended for 2 more years, for 2010 and 2011. And the charitable contributions for individual retirement accounts, individuals aged 70 and a half or older may now donate up to $100,000 of their individual retirement account directly to a qualified charity in a trustee-to-trustee transfer. And by doing this, this charitable gift bypasses reporting on their income tax return, which means that no individual retirement account income is reported and no charitable deduction is reported, which has the advantage of keeping a donor's adjusted gross income lower and thereby avoids any adjustments in Medicare premiums. And this is extended for 2 years to 2010 and 2011. Next, let's go on to the business tax provisions. As I mentioned earlier, there is a 1-year reduction in Social Security and self-employment tax rates. So what this only affects the employee portion of Social Security taxes, which will be reduced by 2 percentage points from the current 6.2% to a temporary rate of 4.2%. But this is only for 2011, and the employer portion remains the same at 6.2%. Also, the Social Security wage base remains the same at $106,800 for 2011. Medicare tax rates are not changed, and they remain at 1.45% each for employers and employees. And similarly, the self-employed persons receive a corresponding 2 percentage point reduction in their self-employment tax. The total 15.3% self-employment tax rate is temporarily reduced to 13.3%, but this is only for 2011. So employers will need to change payroll deductions for 2011 to take a lesser amount from their employee paychecks, and self-employed persons may be able to reduce their estimated tax payments. Okay, another provision affecting businesses is the increase in the bonus depreciation, and this is a significant incentive for businesses. Basically, it provides that bonus depreciation amount for qualifying business assets purchased after September 8, 2010 and before January 1, 2012 has increased to 100%. So businesses can fully depreciate and deduct the cost of these business assets. The requirement is that it has to be what they call qualifying property, which means that the bonus depreciation allowance is only available for new property where the original use begins with the taxpayer. So in other words, it has to be a new, it can't be used equipment, it has to be new equipment, and it has to be property which is depreciable under the modified accelerated cost recovery system and has a recovery period of 20 years or less. So it's basically going to cover all personal property, equipment. It's not going to apply to buildings or real estate structures, but it also applies to off-the-shelf software depreciable over 3 years and to leasehold improvements, what they call qualified leasehold improvement property. Also, the big thing about this increased bonus depreciation is that the bonus is not limited to use by small businesses, and it's not capped at any dollar level. So this is a big difference between bonus depreciation and Section 179 expensing, is that any business can use the bonus depreciation provided that it's new property and there's no cap for any dollar limit. But you have to make sure that the property is new property. And previously, the bonus depreciation for business assets was only 50%. Then for Section 179 expensing depreciation, the 2010 Small Business Jobs Act, which was enacted earlier in 2010, did increase the Section 179 depreciation dollar limit to $500,000 and an investment limit to $2 million for tax years beginning in 2010 and 2011. And then the 2010 Tax Relief Act provides that beginning in 2012, the Section 179 limit will go back down to $125,000 limit and a $500,000 investment limit, and that's for years beginning in 2012. Now let's turn to the estate tax provisions. There is a significant change here from our previous system. The new and unified gift tax and generation skipping transfer tax exemptions and rates for 2011 and 2012, the federal estate tax exemption will be $5 million, and the estate tax rate for estates valued over this amount will be 35%. The estate tax has also become unified with the federal gift and generation skipping transfer taxes, such that the gift tax exemption and generation skipping transfer tax exemptions will be $5 million each, and the rate for both of these taxes will also be 35%. So basically what they've done is they've unified the estate tax and the gift tax again like it was. So let me go back. So basically for the next 2 years we have a unified estate and a unified gift tax rates and exemptions. So for 2009 and prior years, married couples could pass on 2 times the federal estate tax exemptions by including AB trusts in their estate plan. And this was to provide for the first to die so that you could get the full amount of both exemptions for both estates. But the new law eliminates the need for the AB trust planning for federal estates by allowing married couples to add any unused portion of the estate tax exemption of the first spouse to die to the surviving spouse's estate tax exemption. So basically, you don't need the AB trust planning, at least for the next 2 years. So this will effectively allow married couples to pass $10 million on to their heirs free from all estate taxes with absolutely no planning at all. But we need to note that portability was not applied retroactively to January 1, 2010. So as it stands now, this provision is only available for deaths that occur during the 2011 and 2012 tax years. So that completes my presentation, and so I'll now open this up for questions. Are there any questions? So if there are no questions, let me just thank you for attending this this webcast, and I'd like to direct you to our website for Huddleston Tax CPAs. Let me pull that up. And we're available to help you with your tax preparation and any tax questions you have. And our firm's focus is on small business. And so please call us if you have any small business concerns, or if you have any questions on planning for your small business. So I'd like to thank you for attending, and that's it.